When most people think about investing, they often picture day trading, stock tickers, and people shouting at each other. But let me tell you, investing doesn't have to be complex, overwhelming, or dull. In fact, the fundamentals are refreshingly straightforward. Once you grasp them, you have the potential to accumulate millions over your lifetime. Now, here's a critical error many people make that could cost them hundreds of thousands of dollars: jumping into investing without proper preparation. If you're in a situation similar to my frugal Wendy's days in my early 20s, it might seem impossible to even consider investing. But hold on, before you open your first investment account, there are two vital steps that most personal finance experts agree on. First, build up an emergency fund. Start with 1 month's worth of savings and work your way up to 3 to 6 months of essential expenses. Think rent, utilities, groceries, and gas, the absolute essentials for survival. Second, clear off all your debt except for your mortgage. Concentrate on high-interest debts like credit cards, student loans, and car loans. These two steps may take time, patience, frustration, and sacrifices, especially if you're dealing with significant student debt. But once you're debt-free, you'll be truly ready to enter the world of stock market investing. As Warren Buffett wisely put it, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." Compound interest is the reason you should begin investing as soon as possible. Now, I know numbers can be a bit intimidating, so let's break it down. Over a long period, say 40, 50, or 60 years, the market generally yields about 7% to 8% annually. What does this mean? It means your money essentially doubles every decade if you simply let it sit there. For instance, if you invest $5,000 annually from age 25 to 65 with an 8% annual return, you'll have nearly $1.3 million. On the other hand, if you stash that money in your sock drawer, you'd have a mere $200,000. That's a life-changing difference. But I get it. You might have questions like how to open an account, which company to trust, how much to invest, and which stocks to choose. It can feel overwhelming. There are various account types with different fees and tax benefits, which might be where you've gotten stuck in the details. So, let's simplify the process. In the US, if your employer offers a 401k plan with matching contributions, that's where you should start investing, even before fully paying off your debt. Contribute as much as your employer matches. After that, open a Roth IRA if you meet the income requirements. It offers excellent tax advantages and is commonly recommended by personal finance experts. Now, when it comes to choosing a company to trust with your money, there are several great options like Vanguard, Fidelity, and Schwab. They offer low fees and a wide range of investment choices. Some people also consider robo-advisors, which are quite popular. While there are slight fee differences between them, the choice comes down to personal preference. Personally, I prefer Vanguard due to their focus on low fees and simplicity. So, once you've set up your account, what's next? You need to invest your money, but please avoid the temptation to put all your savings into a single company, stock, or a risky bet like Bitcoin. Instead, diversify your investments by putting your money into something called an index fund. An index fund spreads your investment across various stocks, bonds, and securities, reducing overall risk. But you might wonder which investments are safe in the long run while still offering decent returns. A target date retirement fund is a fantastic choice. You choose the year you plan to retire, put your money into it, and it automatically diversifies your investments, including stocks and bonds. Plus, these funds typically charge minimal fees. Now, I know it can seem daunting, but once you've created your account and chosen your investment strategy, the most crucial step is to consistently invest. Timing the market by trying to buy low and sell high is incredibly challenging and often leads to losses. Instead, employ a strategy called dollar cost averaging. This means investing a fixed amount regularly, regardless of market ups and downs. Some months you'll buy fewer shares when prices are high, and other months you'll buy more when prices are low. Over time, this strategy tends to outperform trying to time the market. I vividly remember my initial foray into investing with Vanguard. I knew I shouldn't check my accounts daily, but I couldn't resist at first. However, I eventually learned to stop obsessing and let my investments work in the background. It turned out to be the best decision I made. I now only check every 6 months, and over the past 8 years, I've averaged an 8% annual return. Remember, investing is a long-term game, and emotional reactions to market fluctuations can lead to poor decisions. The key is to stay the course and keep contributing regularly. Now, here's a critical pitfall to avoid: high financial advisor fees. If you have parents using a financial advisor, find out how much they're paying. Many advisors charge a percentage of assets under management, often around 1% or more. Over time, these fees can eat up a substantial portion of your returns. If you need financial advice, consider paying an hourly or project-based fee rather than a percentage of AUM. As you explore your own financial journey, don't lose sight of your goals and the reasons why investing is essential. Money can be a source of joy, and it can help you achieve the life you desire. Start by defining your rich life, the things you want to do and experience. Then, work towards it through strategies like negotiating your salary, starting a business, and of course, investing. Remember, every year your delay investing could cost you thousands or even tens of thousands of dollars. So, join me on this journey towards financial independence and a richer life. Thanks for watching, and don't forget to hit subscribe and turn on notifications for more videos from me. Your financial future starts now.